So let's continue our discussion on investment rules, investment decision-making rules. So let's assume we have two projects that we're looking at, projects, the left one and the right one, A and B. We know that the discount rate or the cost of financing is 15%. Remember that this discount rate reflects the cost of financing. And the cost of financing includes a risk assessment. There is the riskiness of the company, the riskiness embedded in the economy are all part of this discount rate. So if we look at these projects A and B, we've so far talked about net present value and internal rate of return. Net present value and internal rate of return both say that these projects are acceptable. So if you could do both of these projects, you'd want to do them both. Net present value is positive for both, and the internal rate of return is greater than 15% for both. But what if you have to choose one? If they're mutually exclusive, which one's the best? Net present value says that B is better. $93,000 is the increase in value of the company if you do B. Internal rate of return, though, says that if you do A, you get 31% compared to 29% for B. So you get a higher rate of return. But this is a perfect example of asking percentage of what? In this case, you get 31% of 200,000 or of 100,000, or you get 29% of 200,000. Which would you rather have? So the percentage thing, again, internal rate of return has some flaws. We'll come back and address this as we go through some of these other techniques. The next technique is called the payback period. It's the simplest of all techniques. Essentially, it talks about how long it takes to get our money back. If the payback is less than the required time, then you accept the project. Although this is a very simple technique, the challenges are massive, right? It ignores the cost of capital. It ignores the time value of money. It doesn't pay attention to any cash flows that happen after the payback period. So this essential technique, even though it's simple, it ignores risk. It ignores all the cash flows. It's missing some very important concepts that we understand are important. And in the end, it just relies on an ad hoc decision of whether a project is good or bad. If you look at the payback period for A is 2 years, and for B it's 3.3 years. So this says that if you wanted 3 years, project A is best. If you wanted B was 3 years, you would actually say that project B is a bad project. And we know that it's the better of the two projects. So again, the payback period, although it's very simple, gives us a picture of risk to a certain extent. It has, again, some major flaws that we have to be worried about. So let's come back to this idea of conflict then, right? The internal rate of return, the reason it could be different from net present value, one of the reasons why it could be different is because of differences in scale, right? If you double the size of a project, you will double the size of its net present value. However, that's not true with the internal rate of return. So the internal rate of return is not influenced by the size of the project. Another problem with internal rate of return is just when the cash flows occur, right? The internal rate of return is a return, but the dollar value of earnings, a given return, depends on how long the return is earned, right? We talked a little bit earlier about annualizing returns. An internal rate of return that's attractive for a safe project might not be attractive for a riskier project. Again, we need to incorporate the concept of risk, right? Internal rate of return is important but we have to take into account the riskiness of assets. So the higher the cost of capital, the higher the cost of financing, means that the higher return of internal rate of return is necessary to make the project attractive. So if companies are in trouble and are getting riskier, investors want to be paid more for giving us money. If they want to get paid more and we want the money, we have to pay them a higher rate of return. Of course, what that now means, though, is the cost of capital, the discount rate is now higher. So the projects have to be more profitable just to make them look okay. So again, the reason for the differences in risk, differences in the timing of cash flows. One of the things we can use the internal rate of return rule for, though, is to look at the difference between two sets of cash flows. So we can analyze cash flows and try to determine which projects are better based on the cash flows that we observe. So we have these two projects. We have a major overhaul and a minor overhaul. And again, if you look at the cash flows, they're obviously different in size, right? So what is the internal rate of return for each one of these projects? And if the cost of capital is 12%, what should your company do? Now, the spreadsheet that we can use to analyze two projects is called capital budgeting project analysis. If you identify, here's the major overhaul, right? Here's the discount rate. Its net present value is 4.4, and the internal rate of return is 36.3%. The minor overhaul has a higher net present value, $10, but it has a lower internal rate of return. This project analysis utilizes a concept called the incremental cash flows. It looks, relatively speaking, at what is the difference if you do project B instead of project A. So you subtract -10 minus a -50 means we have $40 for cash flow times 0. To find the net present value is -5.63. Should you do project 1? Well, since it's negative, since the change is negative, you shouldn't do 1, you should do 2. The crossover point, though, tells us at what net present value at what discount rate would these two projects have the exact same value, net present value. So the blue line is the minor overhaul and the major overhaul is the gold line here. And if you look, if the cost of capital is 12%, right, the minor overhaul creates greater value than the major overhaul. In fact, anything less than this 20% means that the major overhaul is better than the minor overhaul. But if the cost of capital is more, right? What if the cost of capital was 23%? Well, at 23%, there's still some value in the gold one, but anything greater than 20% and the minor overhaul has a greater benefit to the company than the other one. So what we see is that, again, we have differences in opinion, right? We have differences in outcome depending on which rule you use. The shortcoming of using this internal rate of return rule are the ones we've discussed a little bit further. The internal rate of return might not exist, right? There could be multiple internal rate of returns. And the fact that the IRR exceeds the cost of capital for both projects doesn't imply that either project has a positive net present value. And in the end, if we have individual projects that have different costs of capital, right? If the risks of these two projects are different, and I think if you think it through, they probably are different. Is there a different risk with just fixing something and doing a minor overhaul, or of replacing the entire piece of machinery. I think you can see that maybe there is a difference, if you will, in the riskiness. If there's difference in riskiness, we need to use a different cost of capital. Which cost of capital do we use for the incremental internal rate of return? There is a couple other techniques that we can talk about. This technique is not in the textbook, but I like this technique because it helps us with some of the internal rate of return challenges. So essentially what we want to do is we want to assume that we can reinvest the future cash flows into some investment. And if you remember in the beginning example here, we had a reinvestment rate. We said we could reinvest at 15%. So that will give us what's referred to as a terminal value, or that gives us a future value of these future cash flows. We need to find the rate of return between the investment cost and this terminal cash flow. What this does for us, number one, is it guarantees us a single answer. And it gives us some specific interest rates for borrowing and investing on our decision making. So for this example, you see the modified internal rate of return for A is 22%, and for B it's 24%. So in this case, the modified internal rate of return and the net present value agree with each other. Now, I'm not going to tell you that this necessarily will always be true, but yeah, it takes care of some of the issues that we had with the challenges with the internal rate of return. The profitability index is the last of the techniques to talk about, and essentially it gives us a picture of the biggest bang for the buck. So in this case, you take the net present value minus the investment divided by the investment, or again, you can just take the present value of the future cash flows, divide that by the investment. This will give us what's referred to as the profitability index. And if you look at this, present value are benefits, investment is cost. This is just a relationship between benefits and cost, but it's in a quotient form rather than a subtraction form or a difference equation. If the benefit's greater than the cost, if the profitability index is greater than 1, then you want to do the project. So when we look at these two projects, we can see that the profitability index for A is 1.3 and for B it's 1.4. So the profitability index for B is greater than it is for A. So relatively speaking, using our money for B is being a better servant of our shareholder money than using project A. Now, just in conclusion, let's think about this. What happens if we say, I just want to do A because I like a 31% rate of return? What if the owner chooses that? And this will happen frequently if you talk to small business owners. Most of them don't understand net present value. They understand the return they get on their money, right? It's a challenge. In this case, the company won't be hurt. We just won't be maximizing value. If I were the consultant for this company, I would really spend a lot of time talking about and explaining what net present value represents. In the end, it represents money in your pocket. You can't spend 31%. So that's the end of this chapter, and we will have one more chapter to talk about corporate projects.